Quant is basically a method of managing money where you let machines, data, rules and processes make investment decisions as opposed to individuals making investment decisions. When I'm looking at a mutual fund portfolio, I think 4 to 6 schemes
Same.
which target different size, different style,
Absolutely.
different sectors is probably the way to go.
Yeah,
And different
absolutely.
asset classes.
Absolutely.
But even in those 4 to 6, they can't select all small cap funds.
Ha.
Usually when interest rates are cut,
Yeah.
gold does
Always
well.
does well. Yeah.
When there is a war or geopolitical stress, gold
Like
does
it is
well.
currently.
Everybody needs to replace the definition of do you save money to do you save and invest that money.
Yeah.
If you just follow these basic 3 principles, you should be good enough.
I love it.
I don't think you should find कि best fund ढूंढना है, best stock ढूंढना है. अरे भाई regular कर, consistent कर, asset और liability और expense का फर्क समझ, it's good enough.
बस. Hello everyone and welcome to another episode of Happy Hour with FinCocktail. Today's guest is absolutely amazing. He's a CA, CFA. He's a rising star in the asset management industry. He's a fund manager and heads investment strategy at PL Asset Management. The fund size he manages is over 500 crore rupees. Trust me, you and I are going to learn a lot today from him. Everybody, welcome Siddharth Vora. Hello.
Hi Sayali, what's up?
Not much. I'm just here thinking about your amazing background. Were you always going to end up in finance?
No, not really actually.
No?
No, I think when I was much younger, I always wanted to either be like every other guy, wants to be a sportsman, or eventually also I was very passionate about food. So I thought I'll have some business in the F&B space, which I did actually.
You did?
When I was much younger, I think when I was 16 or 17, I started a company called Saucery, which makes, dips and sauces, gourmet dips and sauces. And eventually then my parents were like, okay, you can do this, but focus on getting your, CA and CFA and MSc and all that done. So they said, get your studies and then we'll let you choose whatever you want.
Wow.
So obviously with that, I had to move out of Saucery and finish my studying. But I always thought I'll just do something in sports. So finance was never a calling as such.
Interesting. So when did this switch happen?
So while I was doing my CA, I found there was a subject called financial management. I found that very interesting. And because I found that interesting, I decided, okay, let me see what CFA looks like. So then I did CFA along with that, just because I found it interesting. And as I finished CFA, I realized, dude, this is unbelievable. It's super fun. It's interesting. Let me do something around this in life.
Yeah.
So I think roughly around 23, 24 is when I decided that I'll do something in the financial markets.
Nice. And then how did asset management happen?
Okay, that was
A longer journey,
A
I'm
longer
assuming.
journey, of course. You first, I started in research, equity research, like most people who want to understand the markets more deeply and understand the intricacies of markets. They usually start with either a research role or an IB role, where they get a chance to, understand and decode companies, balance sheets, cash flow statements, meet the management, visit factories, all of that. So I did that for a year and a half, after which I was moved to the investment strategy research team, where the whole focus was, understanding the investment philosophies and frameworks of global legendary investors. Once I did that, then I started a whole newsletter series based on applying the investment framework of global legends in the Indian markets.
Interesting.
So you take their framework, try to convert it into rules, then create portfolios and identify stocks based on that in India. So I did that for a good 1.5 years as well. And during that, I came across this person called Jim Simons. He's the world's most successful fund manager. I think for the last 45 years, he's delivered a CAGR of 66%.
It's incredible.
And his fund size is so big that he only manages his and his employees' money. There are no investors. In fact, I heard Donald Trump was also waitlisted on his fund and he didn't take him in. So that's when I got introduced to the whole concept of quant investing, because Jim Simons is a quant. He's known as the
investor.
father of quant and the
Yeah.
king of quant. And that's how I came across investing, asset management, quant, just too many things coming together.
Yeah. Okay, so for our viewers now, could you break down what asset management is and
Asset
what quant
management,
investing is and the difference between the
done.
two?
Okay, so asset management is very simple. Whether it's a mutual fund or a PMS or an AIF, we provide the professional service where somebody gives us their money, and our job is to give them returns on that money or grow their money by investing in equities, fixed income, real estate, private equity, venture capital. It doesn't matter what asset class you invest in. An asset manager overall manages
Manages.
other people's money with the simple idea of growing their wealth for them.
Got it.
Quant is a part of asset management. It's not asset management is a fruit and quant is
Like
a car. It's
Yeah.
not like that. It's
like
basically
an
just
orange.
a method of, asset management is the category fruit.
Yeah.
Quant is an orange. Active management is apple. Passive is watermelon. They are all just different types of fruits. So quant is basically a method of managing money where you let machines, data, rules, and processes make investment decisions as opposed to individuals making investment decisions. So, to understand quant, it's also important to understand active and passive,
Passive.
money
Yeah.
management. Passive money management is basically investing in index funds
Yeah.
or ETFs which replicate an index. So, say NSE or BSE has created Nifty 50 index, Nifty mid cap index, Nifty small cap index, Nifty IT index, Nifty bank index. The moment you want to replicate that index and give investors that exact return and risk, that's a passive fund.
Yeah.
The moment you want to say, okay, I'm very good at selecting stocks in sectors, I
will
will
do
choose
it
which
myself.
stocks to invest in, you're an active fund manager because the discretion of the fund manager comes into play. Quant is somewhere in between the two. It uses a set of rules and systems to decide which stocks to buy, which sectors to invest in, how much to allocate to a particular stock or sector, when to exit, in a loss, which investment style to use, what should be the mix between large cap, mid cap, and small cap, what should be my equity and cash mix. So there are so many investment decisions. When your models and systems take these decisions for you, as opposed to a human, it's called quant investing.
Got it. So obviously, the basis behind quant investing is technology,
Yep.
right? And technology is obviously transformative in this industry. How does it affect? When did you decide that this was the path that you obviously after learning about Jim Simons and everybody, but I'm saying when did you decide that that is something that can be applicable in the Indian market and can prove to give you that extra alpha or that extra edge over the rest?
Sure. So, firstly, quant is technology, but it's not only technology. What we like to call it is it's a man with machine approach. Because computers on their own have no intelligence.
Yeah,
They have no brain, they have no understanding.
Call it idiot box.
Yes. So humans actually have what we call the experience, wisdom, knowledge, understanding. Computers bring more discipline, more rigor, the ability to multitask, the ability to test things. That is what the computer brings. So it's a man with machine sort of approach where technology meets financial acumen. It's a combination of the two. Secondly, when I think 5 years ago is when I decided that, quant is going to be my focus area personally and for the organization, and the next decade of growth in PL should also come from quant investing, quant research, and quant based asset management. And there were two reasons for this. One, of course, data. So in US, roughly 35 to 40% is managed quantitatively. 40% plus is managed passively. Roughly 20-25 is active. In India, 82 is active. 17 is passive. 1 is quant. So, I mean, it's a no-brainer that
Correct.
as investors become more sophisticated, as data becomes more higher quality in India, and the talent pool in India expands, where people who understand coding also understand finance. And all of this is going to happen in this decade. So, of course, quant is going to grow. This was the data-oriented reason. it also has a subjective sort of rationale of why I think Quant is great and Quant is the future. It firstly retains the human intelligence while eliminating all the emotions. That's
Okay.
one big advantage.
Interesting.
Secondly, you get repeatable investment outcomes. You are not person dependent to generate returns, you're process dependent. And I think in larger economies, in Western markets, and I think all the global brands that you see, whether it's a McDonald's or a Domino's or Apple for that matter, or Google Maps, these are companies with global scale because they are dependent on processes running the business rather than an individual running the business. And therefore, I thought a process orientation in asset management can go a long way in creating repeatable investment outcomes because the discretion of the fund manager is out of the picture.
Out.
So repeatability was critical. Eliminating key man risk was very, very critical for investors to invest in a fund and for us as a business owner to run this business. Imagine where I'm running an asset management business where every 2-3 years fund managers keep changing.
Yeah.
I don't think that's a very great situation to be in. So in this, at least, we have IP led advantage. We built the IP. We are continuously improving and honing the IP, and we own the IP. So it's a very, very good competitive advantage to sort of have. And the beauty is that people can see the outcome, but people can't see what's behind. So it's not easy to replicate or copy as well.
Yeah.
So I think host of these reasons why I got kind of attracted to Quant as a space of further exploring.
Very interesting. I want to come back to the conversation on removing the emotional bit out of it. But before that, you said that, your clients can see the plethora of results, but can't see the process behind it. What are the different products that you have at PL and what kind of clientele are you targeting and do you currently have?
Okay. So firstly, we operate only quant-based PMSs. We don't have a mutual fund.
Okay.
As of now. So when you are running a PMS, as per SEBI, the mandated ticket size is 50 lakhs. So automatically it's HNI and above.
Yeah.
Usually clients age 35 and above have 50 lakhs of investable surplus to park in one strategy.
Correct. Because obviously you have
I mean, if you only have 50 lakhs, usually people would diversify it at least across 3-4 managers.
Yeah.
So that's the age group, ticket size group. And we're currently running 2 major strategies. One is called Aqua, which is our flagship equity strategy. It's a flexi cap product which invests across large, mid and small cap with a major differentiation of having the ability to change its investment style based on the market conditions. And that's why Aqua, water, can change, take any form, shape, size, color.
Interesting.
And that is pretty much one style or one strategy that has resonated really well with investors, because even in the last, say, 16 months, we've been able to change our investment styles twice in a very big way, which any traditional fund manager could find it hard to go out of their traditional mode.
Yeah.
So usually, investors have predefined styles like value, growth, quality, momentum. And they like to stick to that style irrespective of the market conditions. Based on all the data we've crunched and the back tests we've run, we realized that markets operate in cycles. And in every cycle, which is a macro and market cycle, the investment style preference completely changes. So till 2020, so 2017 to 20, quality did very well. 20 to 23, value and momentum did very well. Now again, we are moving back to quality and low risk. So cycles change. And we said the biggest problem we wanted to solve for investors was them having to time and choose which fund and which style to invest in when. We wanted to create an investment strategy which does all this for them. They just have to give money to one strategy, and the strategy itself decides when to allocate to which style, which sectors, when to go into cyclicals, go into non-cyclicals. So it gives them a lot of adaptability. So I think that really worked out well for us. And I think in my first year, we generated 76% absolute returns and 37% alpha. So 2x the benchmark. Now, since inception, my CAGR is roughly 62%,
Nice.
which is significantly higher than the
Higher.
benchmark as well. So I think outperformance, managing risk, and giving clients a lot of adaptability, all of this is fulfilled by Aqua, which is our equity strategy. The other strategy we run is called multi-asset dynamic portfolio. That is not a pure equity strategy. It allocates between equity,
Multi-assets, of course.
debt, gold, and international equities via ETFs.
Got it.
So again, we're not taking active equity exposure. We're simply
just-
allocating assets using quant models. And that again has yielded roughly 16-17% CAGR over the last 3 years, 22% CAGR over the last 2 years. So it's a moderate product for slightly conservative investors. Aqua is for slightly aggressive investors.
I think this answers my next question, where I'd be like, you have a diverse clientele. How would you tailor your offerings for them? You've already kind of pre-tailored them.
So it's basically very simple. If you're a pure aggressive guy, come to Aqua. If you're a very conservative guy, come to MADP. And if you're somewhere in between, 70-30, 60-40 between Aqua and MADP, that's the way
we can work that out that way. Nice. Going back to a couple of things that you brought up. The first one was about removing the emotion from the investment. This brings me to something which has been important in the investment field, which is behavioral finance, right? There's always a level of investor sentiment. There's always a level of kind of what is the market thinking. How does the process, or how does Quant kind of account for this? And what are the strategies to mitigate that risk that comes along with the behavioral side of it?
Okay. So the way we look at it is behavioral finance and behavioral biases. I can tell you them in very technical methods as well. There's sunk cost bias, loss aversion bias, and there are a lot of
big picture
biases which investors face. But I can simplify them for our viewers. It's basically stemming out of 6 basic emotions. It's greed, fear, hope, ego, regret, and FOMO. There are 2 types of fears: fear of losing and fear of missing out. So
always kind of
every sort of bias comes out of these 6 emotions that I told you, which is greed, fear, hope, regret, ego, and FOMO. And quant strategies are able to rise above them simply because the machines have none of this. These are all human problems.
True, 100%. Agreed. But the market has these problems, right?
So the quant strategies are designed to capitalize on these.
Interesting. So they kind of use...
They use them. They know that this happens.
They know
investors become irrational. They become overly optimistic. They become overly pessimistic.
So it accounts for all of this.
It accounts for all of this, and that is how styles are created.
Okay.
What is momentum?
Correct.
Momentum is basically a lot of optimism and continued optimism. What did well is going to continue to do well because now FOMO is catching in. Those guys who didn't invest when the stock went from 100 to 200 now feel, okay, we missed out. So let's ride from 200 to 400. That's momentum. What is value? Things are so cheap, markets are so cheap, or stocks are so cheap that people feel like, okay, now I want to buy this stock. I want to enter the markets. So that's how markets turn when they are deeply valued. When markets become very expensive, there's another emotion that kicks in. It's called fear of losing. Itna chal gaya hai aur kitna chalega, let's exit. I don't want to lose whatever profit I made. So that's fear of losing. Hope is, I bought this stock, it went down. A quant model tells me, exit this. I will say, he upar aayega. That's hope, which is cutting you. What is ego? I bought this stock.
How can it go down?
मैं कैसे गलत पढ़ सकता हूँ? मैंने तो पूरा रिसर्च किया है. एंड रिसर्च के बाद अभी न्यूज में भी जो पढ़ता हूँ, जो मुझे लगता है वही कंफर्म करता है वो सब. Confirmation bias. So point is, all these 6 things eventually make you train your mind in a way to make mistakes on a recurring basis.
Nice.
Quant models don't have to deal with this.
This is very interesting how they actually use our fears and emotions against us, actually end up doing better. So what would you say about the current situation? Because there is a lot going on right now, right? There is the war situation, there is the oil situation, there is obviously our own markets thinking that, "Arey, yahan tak kaise pahunch gaye?"
So I think across all my media interviews also since 4 months, I've been very, very defensive. I've been very cautious, and of course the structural story of India is in place, but the short term doesn't look so great. And I'll tell you why. As you said, geopolitical stress all around the world. Indian elections are done, but US elections are still to come.
Yeah.
Crude prices are extremely vulnerable to the Middle East, and the Middle East is extremely vulnerable to the wars. So India, being a major importer of crude, is highly dependent on how crude prices eventually pan out. So that is a risk. Other than that, the valuations of Indian markets are also quite high.
Quite high, yeah.
And usually when we are trading at such multiples, roughly around 25 P on the Nifty 50, the chance of re-rating is significantly lower. You can't go to 40 multiple now. So the only sort of returns you're going to make on broader markets is going to be from earnings growth. And given the sort of higher base of the last year, I think earnings growth are also likely to taper off. They are going to be high, but not as high as they were before. So I think moderating return expectations is something investors should build in at this point. Deciding how to create a portfolio to deal with such times where valuations are not in your favor, market sentiment is also quite weak, and there are a lot of global risks. One needs to create a defensive strategy to deal with this, so over the last 4 months, we completely moved from a value momentum tilt, cyclical sector tilt, to defensive sectors, non-cyclical, quality and low vol tilt. And that has really helped us generate good alpha over the last 4 months, even though the markets have been super choppy.
Yeah.
The breath has come off significantly over the last 4 months in the markets. So I think getting defensive at the right time, because our models were able to switch their style completely, has played out really, really well for us.
Well, it's really funny. Now, this is from a retail investor's perspective, but you go through such a choppy market and then you're still hearing, oh, Hyundai IPO, 35,000 crores. And it's incredible. These IPOs come literally at the time when they kind of transfer, I guess, the risk from the basic promoters and investors to your retail investors. Exactly. And then they're like, okay, bhai, now abhi sambhal lo.
So there are very few IPOs, I would say, which come in at valuations which make sense for the investors.
Yeah.
Because when do promoters come with IPOs? When the sentiment is good, there's euphoria in the markets, when they know they'll get a very good and healthy valuation to offload some shares. Usually, I think some IPOs, after they come in, they do very well, but that's a rarity.
Yeah.
Most of the IPOs come in, oversubscribed, listing gains 100-200%, and then they taper off because now everyone is selling.
Reality sets in.
Then the lock-in period ends, and then again a lot of people come out to sell. So I think in Aqua at least, we don't touch a stock till 1 year of IPO.
Nice.
आ जाओ, list करो, 1 साल निकालो, promoter को commentary देने दो. Let the market understand what this promoter's capability is in terms of managing investor expectations. Then we sort of look at these stocks. For the first 1 year, we don't even consider them.
Nice.
However good or bad. Correct. Sometimes you miss out on 1-2 ideas, but that's okay.
It may be worth it considering the the opposite. And of course, the China situation doesn't help, right?
It's the worst actually, because globally, all the foreign institutional investors, they are looking at India and China as the part of emerging markets.
Yeah.
And India is in the 97th percentile. It's the second most expensive market in the world after Taiwan, I believe. And China is in the second percentile. It's almost the cheapest market in the world. So I think China trades at roughly 7-8p. India trades at 24-26p. So China just needed one trigger for all the global money to
switch back,
come to China, or at least some money to come to China. And India needed one trigger for some money to go out. So I was just telling my set of investors also that India is currently in a state where most of the good news is in the price.
Yeah.
And you need one little bad news for a correction. And in China, most of the bad news is in the price. So you need one little good news for a rally to happen.
Yeah.
I think that's what's really played out over the last couple of months, maybe 1 month or so. But I think it's not a very long term situation. I don't think it has too many legs because the amount and the complexity of crisis in China is still quite deep and structural. And the strength of the Indian economy and is very robust, and we have a lot of legs for a long term structural growth. So I think our positives are structural, then negatives are structural. In the short term, you could see some swapping of foreign money from China, India to China, but I don't think it'll last for too long.
So it'll play itself out, hopefully.
Yeah, but that will create volatility in the next couple of months for Indian markets as well.
We've already established that there is volatility in the short term, let's say.
Yeah.
How long do you think this short term we should define as? 2-3
months.
2-3 months?
2-3 months. 2-3. I mean, usually people start discounting news. They'll wait for the next set of announcements to come. They'll see if the quantum of the economic stimulus is in line with the problem and the crisis in China. If yes, they will allocate to China. If no, they'll again sell China. So I think it's going to be quite choppy.
Yeah, fair enough. And moving to the long term, chalo short term ka ho gaya. We know crisis, figuring it out, all of that. When we look at the long term, in terms of retail investors, a lot of them are looking at passive investing.
Absolutely.
That's also, I think, not a mature market in India yet.
Not at all.
Not at all.
17% market share, as I told you.
Yeah, exactly. In the beginning, the
82.
orange.
And US, I said, is roughly 45%. And Vanguard is the world's largest asset manager.
Yeah.
All passive.
Yeah.
So the real advantage of passive is it's low cost. You're not dependent on a person. It's easy to understand.
Yeah,
you replicate an index. And there is no scope of outperformance or underperformance.
Jitna index hai, utna mil gaya, khush.
So investors are not usually disappointed when you're getting something for 10, 20, 30 basis points.
Yeah.
And it's going to perform in line with this.
Yeah.
Then might as well go for passive.
Yeah.
Quant, on the other hand, is not giving you index returns. The whole agenda of quant strategies is to give you alpha or outperformance over the targeted benchmark. So quant has its own sort of niche carved out in the market, which is all usually alpha focused, outperformance focused. And because it is process driven, I think you know where the alpha can come from, because there is a set of rules, there is a philosophy, there's a framework behind quant strategies. So if investors understand that, then they know when will this strategy do well and when it won't. And if the quant strategy is very sophisticated, then it will give you adaptability and not one dimension, multi-dimensional adaptability. Change your market cap mix, change your investment style, change your sector mix, change your beta levels, change your equity cash asset mix. You can change all dimensions of the portfolio based on market conditions. So I think that level of adaptability is one of the big advantages of quant.
Fair, I agree. But does this adaptability also come expensive?
I think quant funds are priced at par with active. Of course, higher than passive, because there is an element of churn and there's an element of restructuring the portfolio on a regular basis. With passive, the disadvantage is just because it's there in the benchmark, it'll be in the portfolio.
Yeah.
They don't have the ability to say, okay, I want to be out of the oil and gas sector, or I want to be overweight IT, or I want to be overweight cap goods. That is something only an active and quant fund manager would have.
Fair.
So the cost of quant is slightly higher than passive, in line with active or between active and passive, but the outperformance is also there. I think 100% of all quant funds in India over the last 3 years and 5 years have outperformed the benchmark, while only 38% of active funds have beaten the benchmark.
Yeah, I knew this about the active funds, which is why I was kind of getting there. Where you compare active and quant funds, the expenses are at par, but the outperformance is far better at.
And the biggest thing, key man risk.
Yeah.
There's no key man risk as such in quant funds and passive funds.
Absolutely.
It's dependent on processes.
Yeah.
At the end of the day, even a passive fund is a quant fund. What is the rule of a passive fund? If the weight of stock A is X in the benchmark, that's the rule.
Yeah.
In
That's
quant,
also
you
a
have more
process.
complex rules.
Correct. So, given all the things that we talked about, including the volatility in the market, of everything that's happening, how would you diversify a good portfolio today? What would your thoughts be?
So I'm going to talk more from a retail investor or a personal investor point of
Yes.
view, rather than what I would do in, say, my equity fund or what I would do in my multi-asset fund. The broad levers of diversification include across asset classes, across geographies, across investment styles, across sectors, and across risk levels: high beta, low beta, mid beta. Any investor who wants a well diversified portfolio should try to balance these five major
Yeah.
aspects of investing. Now, for example, in aqua, we don't diversify across geographies, and currently we are 100% allocated to equity with no cash. So we're not even diversified across asset
Asset class.
classes. But yes, we use a multi-factor approach to investing, which multi-factor or multi-style approach to investing. So we do diversify across styles, we do diversify across sectors, we do diversify across risk levels, and we do diversify across market cap.
Got it.
That's the diversification we provide
Within
to
aqua.
investors within aqua. And the interesting part is we run a 25 to 30 stock portfolio, but every stock has an equal weight, which means that my risk is scattered across 30 stocks. My returns are also coming from 30 stocks, rather than running a concentrated portfolio where 3-4 stocks are giving me
just
returns,
correct.
but bulk
Baki-
of the stocks are underperforming. So I think there's a concept of too much diversification,
Yeah.
like over diversification or over concentration. Both of them are harmful for investors.
Yeah.
What people should target for is optimal diversification. When I look at a stock portfolio, 25 to 30 is a optimally diversified portfolio.
Got it.
When I'm looking at a mutual fund portfolio, I think 4 to 6 schemes
Same.
which target different size, different style, different
Absolutely.
sectors is probably the way to go.
Yeah,
And different
absolutely.
asset classes.
Absolutely.
That's the way to go in a mutual fund
Mutual fund
portfolio as well. So I think having a little diversification is good,
Yeah.
because you don't know when markets change, when
Correct.
styles change, when
Yeah.
things are bad. So having that little amount of diversification helps.
I agree. There's so many of our, followers, clients, friends, all of that. They come to us. They're like, I have 23 mutual funds that I'm investing. I'm like,
Just invest in Nifty 500 and you'll make the same money.
exactly, because eventually all those funds are investing in the same stocks and debt products that are available. So 4 to 6, like you said, great kind of
Yeah, 4 to 6 is a sweet
chotu
spot.
sweet spot, which is amazing.
But even in those 4 to 6, they can't select all small cap funds. One
That also
small cap,
correct.
one quality
Correct.
fund,
Because
one value fund, one
Yes.
momentum fund,
Yes.
one all market fund.
Absolutely.
So diversify even within the
that
4-6.
Yeah, because again, for small cap funds only, if you have, then
Then
you're
it's the
only
same.
you're only catering to that particular market. Okay, so this brings me to an interesting part of the market, and an interesting question that I have gotten multiple times on Instagram, because everybody is just looking for the next new shiny thing, right? So they're like, mutual fund stocks to abhi theek hai, wo to pata hi hai, but give us some alternative investment ideas. And this like growing fad of like, what do you think about like P2P lending, or some AIFs, I don't know, some like random crypto investing in this, investing in that, investing. It's just this alternative investments is a massive new shiny object that retail investors are considering. What do you think about all of them?
So I think PE funds or VC funds or long short AIFs or any sort of exotic AIFs, I don't think they're currently open for retail investors, because
No, they're
1
not.
crore is the ticket size.
Yeah, they're not.
So that whole
No.
sort of product basket is out.
Yeah.
When you talk about crypto, I don't think it's regulated in India.
No, it's
yet.
not.
So I think
Let's
from
not
a
talk about
regulatory
that.
standpoint,
Yeah.
that's out. Probably you can invest via some global ETF or something. There are a lot of platforms which allow you. So I think we also have something called PL Vested, where investors can invest in Indian investors can invest in global stocks and
Got it.
ETFs.
Yeah.
So I think taking a broader exposure to the top ETFs by market cap or something, that's possible.
Yeah.
I still would choose gold over Bitcoin any day.
Right?
Yeah,
I
for
did. I
sure.
did this conversation. I did this calculation just. I mean, like a couple of hours ago, where I compared the price of gold to 2014 to right now. It was an absolute return of 179%, and I'm like, but why am I looking for something which is exotic?
Bitcoin or cryptos give you that every 2-3 months,
Yeah.
100% up,
Huh.
40% down from that high.
Huh, but
So,
that
I
up
mean,
and
from
down
a risk
is
adjusted
very
basis, and
stressful.
so crypto is not a diversifier, it's a pure risk on asset.
Yeah.
Gold is actually a hedge or a diversifier.
Correct.
So,
Exactly.
if you want the benefits of diversification, then
Yeah.
gold is the way to go. Probably silver,
Yes.
because it's got a quasi gold element, slightly higher beta than gold, does well in risk off environments also, and sometimes does well in risk on also because of industrial demand.
Yeah.
So I think gold silver exposures are still quite decent
Yeah.
to hold in today's portfolio.
Absolutely. Silver, for example, this year itself, it's outperformed a lot of assets.
Yeah.
Because even like the rising demand on like the EV space and other industrial usage, like you said, silver has more than just the quality of gold that we look at, right?
Yeah.
Because it's gold you invest in for ki chalo, gold is safe.
Yeah.
I can like touch and feel it.
And I think globally the biggest structural tailwind for gold is now de-dollarization.
Yes.
Central banks are buying gold all around the world
Yes.
because they want to also peg their currencies to gold
To
reserves.
gold again,
So I think
like it used to
it's
be.
a good structural tailwind for gold as an
Yeah.
asset class.
Yeah, absolutely.
And with finally after 4 years, we're seeing a rate cut cycle start.
Correct.
So usually when interest rates are cut,
Yeah.
gold does
Always
well.
does well. Yeah.
When there is a war or geopolitical stress, gold
Like
does
it is
well.
currently.
When the dollar index corrects, gold does well because gold is priced in dollars.
In dollars.
So you need more dollars to buy the
buy
same
gold.
amount of gold. So again, I think gold has a lot of tailwinds.
Yeah.
In a medium term. I mean, right
Correct.
now people will say, okay, it's rallied so much. Wait for a little correction,
Yeah.
do a little regular SIP and
Yeah. And
hold gold in the portfolio.
fair enough. Also, when you think about all of these issues, do you see any inflationary pressures on like that India will face now?
Likely to.
Because we've been
We
pretty
are-
good.
So far, we've been among the more resilient economies in terms of inflation. But I think 3 days back only we've recorded a very high, I think 24-month or 15-month high
Yeah.
retail inflation.
Yeah.
So I think that's a little cause of concern with crude also getting volatile.
That's the
I think
issue.
crude linked inflation is going to be an issue for I think some time. But our core inflation is still well
Still
within the
under
target
control.
range of the RBI. So I don't think that should be a major concern. But there are ways, to manage inflation.
What ways, for example?
So if you're running an equity portfolio, you should have at least some part of your portfolio allocated to stocks that benefit from rising commodity prices.
For example?
Metals,
Nice.
oil and gas producers, not refiners.
Correct.
So when
Producers.
crude prices go up, stocks like Oil India and ONGC do well. They are more upstream. When crude prices go down, refiners do well because their margins
Yeah.
sort of improve. So they are more downstream. So you should have some exposure to them, some exposure to gold, silver because they do well
Of
in
course.
inflationary environments. And definitely, avoid sectors which are prone to inflation. So for example, paint stocks, tire stocks,
Yeah.
chemical stocks, all of their raw material is predominantly crude and crude linked.
Yeah.
So I think reducing exposure to such sectors and stocks would at least shield your portfolio
Yeah.
for now.
That's so intuitive, right?
Yeah.
Just kind of
So what
balance it out.
sectors you choose,
Yeah.
what stocks you choose,
Yeah.
कौन crude consume करता है,
Correct.
कौन
कौन
crude
बेच रहा
linked
है.
बेचता है. That's it.
Simple. Nice. So simple. Nobody's actually said it so simply before. So I'm quite glad to hear that. So now that you've simplified this for us so easily, I want to dig in a little deeper and ask you something that we ask everybody on the show because it is a finance podcast. It's a personal finance podcast. So I'd like to know what are some of the strategies that you use personally to manage your own money? Because I'm sure business and personal lines may become blur, but I doubt that you don't take these calls yourself because come on.
No, we have a lot of in-house research also, and I'm personally my investments.
Of
I
course.
personally look at them myself with a lot of research support
Yeah.
from all the sources within the PL group.
Uh-huh.
So I think in terms of personal finance habits or strategies, I have three major points to
Okay.
make. First is savings is not putting money aside. It is actually investing it,
Yeah.
right? So everybody needs to replace the definition of do you save money to do you save and invest that money.
Yeah.
Because saving means what? Every month I saved 1 lakh rupees.
Correct.
Where have I parked it? FD? Bank account? What do I do with that money?
Exactly.
So I think it's very important to park that money
Correct.
into assets.
Absolutely. You are
Second-
doing my job for me because I'm tired of saying this again and again.
Second, it's consistency, discipline, and being regular with saving plus investing. And finally, the thing that is very important is understanding the difference between assets and liabilities.
Okay.
I think assets are anything that you invest your time or money now, and it can yield or grow in value in the
Correct.
future.
And-
Anything that has medium to long term value creation, value addition, that is an asset. And it's not just money, it's also time. You invest 1 year in, I don't know, studying something, doing an experience, learning a course, learning a new skill, investing your time and money in any of those will also add value in the future.
Correct.
Liabilities or expenses are something where you put your time and money now,
And it's gone.
get gratification, but medium to long term में उसका कोई value add नहीं है. So I think understanding this definition of assets versus liabilities is critical. Understanding that saving is not saving, it's saving plus investing.
Yeah.
And being regular, consistent, and disciplined in your
Yeah.
approach to investing. If you just follow these basic three principles, you should be good enough.
I love it.
I don't think you should find कि best fund ढूंढना है, best stock ढूंढना है. अरे भाई regular कर, consistent कर, asset और liability और expense का फर्क समझ, it's good enough.
बेस्ट फंड जान के क्या ही कर लोगे.
Best or worst में भी चलो, you can make some alpha, but I think you'll lose more alpha trying to find the best
that
thing
exactly.
than in just being regular and disciplined about it.
Absolutely. I love these three concepts that you have kind of highlighted so simply, and it's so easy for anybody to, kind of follow. I wanted to ask you this just because, as a family, because, you are a fund manager, this is your work and home and everything. Do you discuss money at home? Is it like a dinner table conversation?
It is because all of the family members
Yeah.
are working in the same field, in
Yeah.
the same industry. My mother is the chairperson and managing director of PL Group,
Nice.
and my family is fully invested in the PL Group. We
Yeah.
own 96% of the equity. My wife, who's also a chartered accountant and an ex-investment banker,
Oh my God.
is also part of
So
PL.
many padha likha people.
So the whole family is into the business.
Yeah.
So 100% it does happen
Mhm.
that at least 1 hour, 2 hours after we come back home, we will have these micro conversations
Yeah.
around topics that we need to resolve with each other,
Yeah.
or decide for the company, or
Fair enough.
important strategic decisions that we need to take. So I think, of course,
Fair enough.
it's not avoidable when three people are working
In the same space, yeah. But it must get difficult also, right? It's like you're talking shop all day. But if you love it, then
Yeah, if you love it, you know what is what is there at the other side of the
Yeah.
tunnel. Then sometimes it feels like it's worth it.
yeah.
Sometimes it feels like यार अभी तो कुछ
Correct.
बात काम का
बस
बात
हो
ही नहीं
गया।
करना है बस.
बस हो
We
गया।
spent ourselves already. Now let this conversation
Yeah.
be.
Fair enough. Okay, getting back to PL a little bit. What are some of the key factors that you would say are important for an asset management company to build trust with their clients? Because let's be honest, it is money we're talking about. It's growing it. The moment you kind of deliver the results, clients sometimes be like, results to like, you were going to deliver only. The moment there's some sort of volatility, they're like, Arey, what are you doing? It's a little bit of a lose-lose situation at that time.
Again, I think as a group, there have been some principles that we followed since 1944 for the last 80 years.
Wow.
And we've become experienced enough to know what really builds client trust. It starts also from personal integrity.
Fair.
And I think PL as a group is mainly known in the market for its trust and integrity.
Yeah.
That's the core part of our ethos. And whether I talk about from all the legacy old clients and families we've been catering to for 8 decades, or from a regulatory or compliance standpoint. Ethical standards, integrity, transparency, trust, all of these things are we are very big on them.
Yeah.
Like we might let go of some business if we find it little
Correct.
complicated or
Gray
conflicting.
area.
Yeah, if it's in any conflict of interest with clients, then I think we'll pass on it.
Fair.
And that's how we've sustained, I think, 8 decades, so many market cycles. Can you imagine?
8 decades.
GFC, COVID, 2001, all the ones before that.
Yeah.
I think
Wow.
Harshad Mehta.
Harshad Mehta, insane.
So many cycles, so many crises.
Yeah.
And I think
it's important for this trust factor to be top down, because
Yes.
unless it's there at the top management level, it's never going to kind of trickle down, and everywhere it's not going to be, understood that this is
Exactly.
what is important to us, and we're not going to budge on this.
And these things are, very easy to hear. Trust, transparency, integrity.
Very difficult to.
But how do you put it in practice? So I think 3 actionable points, which, sort of I believe that help us do this. One is honesty. Honesty means this is the fact. I'm going to convey it with honesty to my client, to my investor. Second is realism. There is a way to market a product. Okay, this is God. This is gold. This is unbelievable. This can't fail. You have to invest. Then there's a more realistic way.
Yeah.
If your risk appetite is this, if you're okay with so much drawdown, if you're okay with so much volatility, if you expect return between this to this range, this is a good strategy for you. If you're okay with your capital being, down by 20%, but on the longer term basis, you expect 22 to 25% compounding, this is a good strategy for you. You need to be honest based on facts. So honesty and realism go hand in hand. And I think the final principle of, doing this, the winning clients' trusts is to do with value addition.
Yeah.
One is you want to do courier service. I got something from here. I forwarded it to my client. Value addition means I got something from here. I apply my mind. I analyze it. I put in my own opinion on it. Then put it to the relevant client.
Correct.
So I think PL as a group has always been more of an advisor than a broker. We've always tried to tilt more towards value additive businesses where research is the core pillar. And I think if I look at my total, team strength on the research side across the institutional equities, retail, wealth, asset management, it's nothing short of a 75-member research team.
Wow, that's amazing.
Technical research, derivatives research, fundamental research is obviously 45-member across sectors, quant research another 20 members, currency and commodity research, wealth research. So I think it's a 70-80 member research team, and research is the bedrock and pillar of all the information that the group creates and conveys to clients. So I think having this sort of foundation
strong,
and basis of research is very important. Only then can you add value to clients.
Yeah.
Otherwise, you're just a broker. Then might as well be a discount broker.
Yeah.
You don't need to provide any advice. That's not the road we've taken.
Yeah. But that's really nice. That's really amazing to see that, because foundationally you're so strong. That's where you can build such a big legacy, like you said, for 8 decades. Incredible. Okay, this is just again popped up into my head, but quick 3 tips for somebody who's young and wants to get into asset management. What would you say?
Oh, young and wants to get into asset management. Read a lot about everything that can affect the markets, which means business news, corporate news, results, economy, US markets, how markets operate. So I think reading a lot is a good starting point to just understand the basic moving parts. Second is curiosity, max curiosity.
Yeah.
Because when you read something, it should pop up 6 questions in your mind to understand, okay, this happened. What is the next level effect of that? Why is this caused? Why was that caused? What will it impact? If you have that whole, channel of thought which leads you to understanding all layers of something, that is when you're better suited for this industry.
Interesting.
Because there you can be 2 types of readers. I read it, I know it. I feel
Okay.
gratified.
Huh.
I read it. I know this, but I don't know why this happens like this. And I don't know the third level derivative of that. If I have the curiosity to go to all those levels, is when you broaden the mental muscle of sorts.
Yeah.
So I think reading is very critical. Curiosity is very critical. And finally actually working in this field,
Yeah.
whether it's equity research, investment banking,
Just get into the field. Start working there.
doing an internship or any asset management firm, all of that is important. And finally, I would say also some relevant education helps.
Yes. Yes.
Because at the end of the day, you're managing money.
Correct. And it's a technical field, let's be honest.
Highly technical field. You're managing money. You want people to trust you with their wealth.
Yeah.
It's simply saying that, would I go to a doctor who's not actually a doctor but a self-proclaimed doctor? I wouldn't. MBBS नहीं किया, doctor का degree नहीं है, तो क्यों जाऊँगा उसके पास?
Yeah.
So if I'm going to be so cautious with my health, I'm going to be equally cautious with my wealth. So get yourself educated enough that, when people are giving you their money, they feel, this guy is qualified enough to handle my money.
Yeah.
So to summarize, reading, curiosity max, education, relevant work experience. All of this is needed and it's a journey.
Yeah.
You can't say, I'm 21, kal se main chalu hai. Aise nahi, bhai, you have to really invest and patiently give your time to this.
Also, who's going to give you the money to invest or to manage if you're just like, you don't put in that work and show that, you are capable of handling that.
Patience and perseverance, if you want, as the fifth point, is key, because you can't build this set of knowledge, this set of mental, you need to connect so many dots. You can't connect these dots overnight or in 1 year.
Yeah.
You really need to internalize it. It has to be a second nature
to you. Yeah.
If gold is going up, why is it going up? If these sectors are going to correct now, why are they going to correct? There is a fundamental trigger to it. There's an economic trigger to it. You just need to have spent enough time to know this as basic ABC.
Yeah. Nice. Thank you so much, Siddharth. Thanks. This was absolutely insightful. I think I learned a lot. I loved some anecdotes that you gave us as well. And I think our listeners are really going to enjoy this one.
I hope so.
Yeah, I'm sure I enjoyed it. So they are also going to enjoy it.
It was fantastic, talking to you, catching up with you. And the way you hosted the whole podcast, very effortless, very easy and very smooth. And I think a lot of viewers will benefit just by the quality of questions. It's also what kind of answers I give is highly dependent on the kind of questions you ask. I think you've done a fab job.
Thank you. Thank you so much.
So guys, do like, share and subscribe to FinCocktail's channel. They're doing a fabulous job in creating investor awareness. And it'll help all of y'all, become better with your personal finance, better investors. And it's very important in today's age because podcasts are what books used to be like a decade back. You're getting insights from different people, different industries with different life experiences who've done something commendable in their life. So I think listening to podcasts is a great way to, upgrade yourself, improve your skills and enhance your body of knowledge. So definitely kudos to them to do such a fabulous job. So
Yay. Thank you so much.